Exactly where market pullbacks stop. Predict the bottom of a market retracement using previous Wave 4 consolidations, estimating correction depth.
Exactly where market pullbacks stop. That is the holy grail, right? Welcome back, everyone, to day 13 of our Time and Cycle Mastery 60 Days series. Today, we're solving the ultimate trading mystery. You know that feeling, right? You're staring at a dropping chart, sweating a little bit, wondering, is this just a temporary dip? Or is the bottom literally falling out of the market? Well, that fear of the unknown, that's exactly what we're going to conquer today. Exactly where market pullbacks stop. It's a massive claim, I know, but here's the thing. Mistaking a completely natural, healthy market correction for some sort of total trend reversal is, hands down, the #1 reason traders panic sell. They assume the absolute worst, they liquidate their positions, and then, boom, the market surges again. So what if we could actually map those pullbacks before they happen? So here's our roadmap for today's explainer. First, we'll look at where market pullbacks actually stop. Then the anatomy of corrective waves, followed by the guideline of depth. After that, we'll pinpoint levels using Fibonacci, and finally wrap up with how to avoid some really common wave mistakes.
All right, let's jump right into part 1, where market pullbacks stop. You know, it's a fundamental truth. Markets just don't move in straight lines. They push forward, they pause, and they retrace. According to Elliott Wave theory, the market naturally unfolds in this continuous, predictable cycle. It moves in a basic pattern of 5 waves up. We call those impulsive waves because they move with the main trend. And then that's followed by 3 waves down. These are your price reactions pushing back against that primary trend. Put them together and you've got a complete, repeating 8-wave cycle. Which brings us to section 2, the anatomy of corrective waves. Okay, so whenever you see the market correcting, what you're actually watching is typically a 3-wave structure fighting a battle against that massive 5-wave impulse that came right before it. Think of it like this. While impulse waves are all about pushing progress forward, these corrective phases, that's just the market digesting that progress. Actually, fun fact, most market analysis is spent trying to navigate the reality that markets are stuck in a corrective state a huge percentage of the time. This setup brilliantly illustrates the whole dynamic. Notice how the impulse wave drives forcefully upward, creating these higher highs across 5 very distinct subwaves. But then look at the reaction. That corrective wave is clearly retracing that hard-earned progress, forming this sort of jagged, downward zigzag. It's essentially a visual representation of the market taking a deep breath and, frankly, shaking out the weak hands before it decides on its next major move.
Now these pullbacks, they're almost always going to take one of 3 structural forms. You've got your zigzags, those are your sharp, quick corrections. Then you have flats. You'll usually see flats pop up in super strong trends where the market is desperately trying to pull back, but the sheer momentum just keeps pushing everything sideways instead. And finally, triangles. These represent periods of tight consolidation right before a massive breakout.
Moving right along to section 3, the guideline of depth.
Pay attention here because this is your absolute secret weapon. It's called the guideline of depth. Elliott Wave theory states that pullbacks very frequently bottom out in the exact price territory that was established by the preceding 4th wave. Now, to be clear, this doesn't necessarily mean it's going to perfectly tap the absolute rock bottom of that previous 4th wave. Rather, it's going to reach somewhere into the span or the general territory established by it. It's honestly a phenomenal roadmap, and it's built right into the price action itself. Because of this guideline, you don't have to just close your eyes and guess anymore. That previous Wave 4 span acts as this incredibly high probability support zone. It's a highly reliable staging area where the correction tends to finally run out of gas and where the next massive impulse wave is super likely to kick off. You are literally tracking the footprints of past market behavior to forecast future support. How cool is that?
Let's layer in some math with section 4, pinpointing with Fibonacci.
So if you want to apply this yourself, all you need to do is follow 3 simple steps to overlay those magical Fibonacci percentages right on top of your Elliott wave count. First, you identify the impulse wave. Second, you anchor your fib tool from the absolute low up to the high. And third, you laser focus on that sweet spot between the 38.2% and 61.8% retracement levels. Let me tell you, when your Elliott wave target aligns perfectly with a major Fibonacci level, your technical argument for a reversal becomes incredibly strong.
Just look at how this plays out. You anchor perfectly from the swing low right up to the high. Then you just watch as the market pulls back, kind of stepping down through the ratios until, bam, it finds solid ground and reverses flawlessly right off that 38.2% retracement line. It's a beautiful example of absolute confluence. Now, keep in mind, different waves actually have completely different personalities, which means they're going to respect different Fibonacci levels. For instance, expect wave 2 to cut deep into previous profits. We're talking usually pulling back 50% to 61.8%. And it often ends on super low volume, totally tricking people into thinking the main trend is dead. Wave 4, on the other hand, well, she's usually a lot shallower. It often only retraces about 38.2% as it just chops sideways and builds a really strong base for the next push.
Okay, on to our final segment, Section 5, Avoiding Common Wave Mistakes. Listen, the absolute biggest trap beginners fall into is treating Elliott Wave like some sort of rigid guessing game. In reality, it's a strict, rule-based forecasting system. You've got to strike a balance here. Yes, you have to follow the core rules strictly, but you also need to stay completely objective and flexible the moment the market structure evolves and throws new data your way. There are 3 fatal mistakes you need to avoid at all costs. First up, misidentifying patterns. Like, you really don't want to confuse a basic 3-wave correction for full 5-wave impulse. Second, and I can't stress this enough, ignoring Fibonacci confluence. If you're relying solely on wave counts without that mathematical confirmation backing you up, your accuracy is going to drop dramatically. And the third mistake, overcommitting to a single wave count. Never, ever get emotionally attached to your forecast. If the market invalidates your count, you scrap it and adapt immediately.
So how do you actually know if your count is invalidated? Well, if you memorize nothing else from today's explainer, memorize these 3 unbreakable rules. Ready? 1. Wave 2 never retraces 100% of wave 1. 2. Wave 3 is never the shortest impulse wave. And 3. Wave 4 never enters the price territory of wave 1. Actually, let's just say it very plainly. Breaking any single one of these rules instantly and completely invalidates your entire wave count. Period. There are no exceptions.
So, now you've got the exact formula to estimate correction depth. You know the mechanics. But the final challenge? That's conquering your own psychology. Think about it. When that target finally hits, when the market has pulled back perfectly into that wave 4 territory, right onto the 61.8% Fibonacci level, and the news headlines are absolutely screaming that the sky is falling. Are you going to be brave enough to step in and buy when everyone else is panic selling? Because honestly, that is where true mastery begins.